Welcome, you're watching MF Corner. Now, for all the retail investors out there, for too long, you've been judging your return, your risk in the schemes, with just English words saying that, oh, either the risk is too high, too low, or the returns are good, bad. No, it's time to actually pinpoint all of these factors to a number so that you can better assess your own scheme as well as how it stacks up against various other schemes. The way to do it is to have a measure called equity ratios, and there are many, many different kinds of equity ratios. What are the most important ones? How do you read them? Where do you find them? And how do you judge one against the other? Joining in to explain all of those points is Mohit Gang, co-founder and CEO at Moneyfront. Mohit, good afternoon. Thanks very much for joining in. We're going to get to the ratios right away, right? So the 5 that you have chosen for us is alpha, beta, standard deviation, Sharpe ratio. And the last one, I'm going to keep it a surprise because I myself don't know very much about it. So I'm going to leave it to Mohit to actually explain it. But let's start off with alpha. Now, on the very face of it, we just know alpha as that little bit extra that you can get by way of returns. Is that so simple? What is alpha for a retail investor? Where do they find this ratio and how do they judge it?
Hi, good afternoon, Sumaira. Yes, look, I think what has of late been happening in the markets is that everyone tries and judges a scheme by a simple lens of returns, and no one has actually ever bothered to figure out whether that for same kind of return, is there a fund which can take a lesser risk and deliver a similar kind of return. So these are perhaps the ratios which will tell you that what's the risk return profile of a scheme. Right, straight on jumping to alpha, you can call it alpha, you can call it Jensen's alpha. Very simply put, alpha is what your fund manager is delivering for you, what you are paying for the fund manager. Actually, alpha is his ability, his performance, everything, right? So if a scheme delivers only what the benchmark is doing, so if you, let's say, buy a large cap fund and it is just delivering what the index is doing and it's not outperforming the index, then perhaps there is no alpha to it, right? So when we compute alpha, or when we take a look at the alpha figure or the alpha number of a scheme, it tells us that whether the fund manager in that scheme has been able to generate excess returns over the benchmark index. And consistently, if a scheme does that, that means the fund manager is doing a great job. You should figure out for schemes which are delivering positive alpha. For schemes which are not delivering positive alpha, you might as well be invested in the benchmark in a passive way. So that's broadly alpha.
Okay, so you have actually sent us a comparison of very many mutual funds. Do you want to run us through, how an investor should actually read what that number denotes?
Okay, so I will just open up that screen because I don't have the screen in front of me. But so look.
Okay, let me just read it out for you for your comment. Okay, so we have the ABSL Frontline fund, which has an alpha of minus 3.81. Some other funds have alphas of 4 plus, or minus 0.31, minus 1.75. So basically, if the alpha is severely a negative number, or it's a larger negative number, what does that mean for an investor? And if it is like for an example, one of the funds you've given us is the iPru index fund that has an alpha of just minus 0.8 because it tracks the index. So if somebody has a number which is positive from there on, what does a alpha close to 4 indicate?
Okay, so alpha close to 4 is like a superb performance. Basically, you will have to just check because it's too high an alpha, which is 4% over and above the return of the benchmark index. So if the benchmark index of excess blue chip is Nifty 100 TRI, let's say, that means the fund has been beating the index by around 4%. In this case, you will have to just check whether consistently this has been happening, because one-off number or one-off month can be fairly high because of some abnormal performance. But if consistently a scheme is beating the benchmark with this higher margin, it's a fantastic scheme to buy. For schemes which are marginally negative, marginally positive, that's a neutral zone. You are as good as in the scheme as in the benchmark. Index fund will always have no alpha because obviously you're tracking to the index. It will just have minor tracking error, and that is what is getting reflected out here. But a very high negative is a sure warning sign, and you need to watch out for that.
Okay, so it's not just enough that your scheme has, good alpha. You need to see how consistent that is. Okay, Mohit, what about beta then?
Okay, so beta basically is a measure of volatility, or it's actually a measure of systematic risk in the fund. Simply put, beta actually tells you two things: whether the scheme is performing in line with the benchmark, and what is the sensitivity of the scheme's performance with the benchmark. So let me just take an example to make it very simple. Let's say a scheme is delivering 5% return in a month, okay, and the benchmark index has delivered 6% return. Okay, so the beta out here will be less than 1 because benchmark is given 6, scheme has given 5. On the negative side also, if the scheme, if the index falls -6 and the scheme falls only 5, that means the volatility of the scheme, or the sensitivity of the scheme to the benchmark is fairly less, and hence this is a good fund. So lesser beta indicates that the scheme is less volatile.
Okay,
And an index will always have a beta of 1 actually. So you can judge by that.
yeah, so we've just listed out all the funds that you have sent us, and in that you can see the index fund has a beta of 1, and from there you can judge the others, and most of them are actually pretty close to 1, and a few schemes are of course less volatile. Okay, standard deviation, this is perhaps the most common terminology of the lot that a lot more investors would have heard of, and this is, would you say, the best measure of risk?
Yes, perhaps the most commonly used measure, but I find it very so in a colloquial sense, people use it very rarely actually. And so when you go to an investor, let's say I've been into a client-facing role for many years now, where we meet number of investors, and the common question that an investor will ask you is, how much can I lose in this fund? What do you think can, how much be the negative in this kind of a scheme in a negative scenario, right? And perhaps most of the times the answer is more literal and less mathematical in these kind of scenarios. But if you use this number of standard deviation, which will actually show, let's say the average return of a fund is 10% and the standard deviation is, let's say, 4%, which will show that 68% of the times the fund will actually either deliver between 10 minus 4, which is 6%, to 10 plus 4, which is 14%. So that's the range of returns. So standard deviation will actually tell you the volatility as to how much can the returns of the fund move in a particular range. So that's how you track standard deviation. You can perhaps answer it more mathematically when an investor asks, what is the kind of downfall I can see in the fund.
Okay, so this is good for those kind of measures, and we will do justice to each of these measures also later in the show, but we're going to run out of time. So Mohit, very quickly, you want to tell us Sharpe ratio?
Okay, so basically Sharpe is risk adjusted return. Now look, the three key ratios were alpha, beta and standard deviation. Now whatever combination you want to use, let's say you want to judge how much a fund is delivering over and above the benchmark or over and above the risk-free rate, divided by the risk which the fund has taken, which is the standard deviation. So you tell return per unit of risk. So higher the Sharpe, the better a scheme is. If you find a scheme with a 0.5 kind of a Sharpe, which means the fund manager is taking less and less return to deliver you more and more returns, right? Two schemes giving you same return, which is, let's say, 10%, but one running a higher Sharpe will mean that the scheme has taken less risk to give you the same return. So more often than not, I think people need to understand the psychology of these risk parameters than the mathematics of it. If you just get the risk right usage, then I think people will be able to judge the schemes in a more fruitful manner.
All right, and Mohit, we've run out of time, so we'll keep the fifth ratio for another day. And also, it's not sufficient to see any of these ratios in isolation. So we'll tell you next time how you can actually, bring them all together. And therefore, what does that indicate? Mohit, thanks very much for your time this afternoon.
Thank you
we'll
so
wrap
much
up on MF Corner. Do stay tuned. Closing Bell joins you next.